Hello viewers, so welcome to my channel. I'm Hasham Ali Khan. So now I'm starting the next problem on cash flow statement, that is problem number 4. Till the last video I have completed 3 main problems and 12 short problems on cash flow statement. So if you have watched the earlier videos, definitely you got the complete idea regarding the format, how to make the cash flow statement according to AS3. So I have explained you in detail regarding operating activities, investing activities and financing activities. So every video is linked with one another. If you join in between, you may not be able to understand. So if you want a complete grasp, just follow my instructions. Watch the video till the end. Keep a sequence of watching one video and the next video. Then only you can get the complete grasp on the subject. If you have not watched the earlier videos, I suggest you to go to the playlist of my channel, select the subject Financial Statement Analysis. This is the name of the subject. Under that you find the videos of cash flow analysis. So watch the starting 3 videos, you will be completely acquainted with the concepts and terminology, how to make the cash flow statement. Starting videos, if you watch, definitely you can be able to know how to calculate cash flow from operating activities, cash flow from investing activities, cash flow from financing activities. Now I'm starting the 4th problem. But before starting the problem, I expect my viewers to have a printout of the problems which I have given in the link under my description. So take a printout and keep it ready. I'm starting the 4th problem. Prepare cash flow statement from the following balance sheet as on 31st December 1993 and 1994. The current year is 1994. So we have to make cash flow statement for the year. Only balance sheets are given. 2 balance sheets are given, 1993, 1994. We have to compare each and an item of the balance sheet and see which item is increasing, which item is decreasing. Accordingly, we have to make the cash flow statement. Now here you can see on the board, cash flow statement for the year ended 31st December 94, 2 columns, amount column. First of all, cash flow from operating activities. First of all, we should see the profit and loss account balance. So in the balance sheet given, you can see the last item, profit and loss account. In last year balance was 11,000. Current year balance is 14,000. So last year profit and loss account balance was 11,000. Current year it has become 14,000. So how much increased? 3,000 rupees increased. So I am writing increase in profit and loss account, 14,000 minus 11,000, 3,000 is the increase. To this we have to adjust for non-cash, non-operating items. Items means it may be an expense or it may be an income. If it is a non-cash and non-operating, we should take it here. Now we have to compare. So here it is given plant asset side. Plant last year value was 46,000 and current year value is 45,000. 1,000 rupees plant value has decreased. Now there may be 2 reasons. The first reason may be it may be decreased due to depreciation. Second reason may be there may be a sale of plant. On account of depreciation, the plant value may decrease. On account of sale also, the plant value may decrease. So nothing is given regarding what had happened. So we will make the assumption that the decrease in the plant is on account of depreciation. This is our assumption. So I have taken depreciation on plant 1,000. Only one item is there, non-cash item, that is depreciation. Now add up 3,000 plus 1,000, 4,000. This 4,000 is called operating profit before working capital changes. Operating profit before working capital changes. To this we have to adjustment for working capital changes. So many problems we have done in the last video. So current assets and current liability we have to check. And you have to remember the rule. What is that rule? I will again write on, because if you remember this rule, easily you can adjust the working capital changes. What is the rule? Increase in current liability and decrease in current asset. These will be added. This is the rule. Only one rule if you remember, automatically the other rule will be opposite. Increase in current liability is added. So decrease in current liability should be deducted. Decrease in current asset is added. So increase in current asset should be deducted. This rule you have to remember for adjustment of working capital changes. Now see the liability side. Liability side, we have only one current liability, that is creditors, accounts payable, trade payable. So creditors last year 16,000, current year 18,000. Last year 16, current year 18. There is increase in creditors. Increase in creditors will be added because creditor is a current liability. So increase in creditors, you can see. Increase in creditors plus 2,000, add up. Next come to asset side. Asset side, debtors. Debtors are the trade payables. Earlier it was called debtors. Nowadays it is called as trade payable according to new, Schedule 3 of the Companies Act. So debtors. Last year debtors 9,000. Current year debtors 7,000. Debtors have decreased. Current asset decreased. It will be added. It will be added. So decrease in debtors will be added 2,000. Now come to stock. Stock is nothing but the inventory. Old terminology stock, new terminology inventory. So stock last year 5,000, current year 9,000. Increase in stock. Last year 5,000, current year 9,000. Increase in stock. So increase in current asset will be deducted. Increase in stock deducted. So increase in stock deducted minus 4,000. That's all. All the current assets and current liability we have considered. Now 4,000 plus 2,000 minus 4,000 plus 2,000. So ultimately 4,000 remains. This is the cash generated from operations before tax. Cash generated from operation before tax less income tax paid. There is no income tax given in the problem. So just put a dash for the sake of formality. We should write the format. Then 4,000. This is the cash generated from operating activities. See here, according to AS3, this is the format and this is the method of preparing cash flow statement. Even terminology also you have to remember. The same terms you should use. Now come to next, cash flow from investing activity. There is no cash flow from investing activity. Actually, investing activity are the activity relating to purchase and sale of fixed asset and non-current investment. We don't have non-current investment. And fixed asset also, one fixed asset was the plant. And that plant was decreased on account of depreciation we have already taken. So there is no cash flow from operating or from investing activity. So cash flow from investing activity dash. Now cash flow from financing activity. For financing activity we have to compare the share capital and debentures. Only two. So share capital last year 20,000, current year 25,000. So during the current year shares issued. So I will write down issue of equity shares 5,000. Issue of equity shares 5,000. Now debentures. Debentures last year 15,000, current year 12,000. So debentures decreased. Why the debentures decreased? Because the company has redeemed the debentures. Redemption of debentures. If the debentures increased, it means issue of debentures. If debentures decreased, it means a redemption of debentures. So here, redemption of debentures, cash outflow. When shares are issued, it is inflow. When redemption of debentures are made, it is outflow. So outflow in bracket. So 5,000 minus 3,000. 2,000 is the cash generated from financing activity. Now outer column you take the total. Outer column 4,000. 4,000 plus 2,000 is 6,000. This 6,000 is positive. This 4,000 positive, this 2,000 positive, so 6,000 positive. If you get positive, you should write down net increase. If you get negative value, net decrease. So you may get increase or you may get decrease. Anything you may get. Positive if you get, you should write down net increase in cash and cash equivalent. To this we add the last year's cash. So in the balance sheet you can see the last year's cash was 2,000. In the balance sheet last year's cash 2,000. So cash and cash equivalent at the beginning of the year. Last year's closing balance will become current year's opening balance. The closing balance of 1993 will become opening balance for 1994. So 1st January 1994. 1st January, yes, 1st January 1994. 2000 is given in the problem. Now you add up 6000 plus 2000, 8000. This is the cash and cash equivalent at the end of the year, 31st December 1994. So how much? 8000. Now you confirm whether we have done correctly or not. In the balance sheet, cash should be 8000. So we are given cash 8000 in 1994, and we also got 8000, 6000 plus 2000. That means our calculations are correct. If you commit any mistake in calculating, in taking all these items, then definitely this will not tally. The lastly cash and cash equivalent at the end of the year, this will not be same what is given in the balance sheet. So here in our problem, balance sheet amount is 8000 and we also got 8000. That means our calculations are absolutely right. That's it. So this is the problem number 4. Now I am coming to the 5th problem. From the following balance sheet of Rohit Limited as at 31st March 2016 and 31st March 2017. So current year 2017, last year 16. You are required to prepare cash flow statement. So we are given the balance sheet in vertical form. New format balance sheet is given. Equity and liabilities, shareholders fund, share capital. Share capital last year 2016 it is 1 lakh. And current year 2017 it is 1,50,000. So last year share capital 1 lakh, current year it has become 1,50,000. That means during the current year shares were issued. The issue of shares will be taken in financing activity. Issue of shares will be taken in financing activity. You can see here cash flow from financing activity, issue of shares. So all these points you have to remember. Then second, reserves and surplus. Actually reserves and surplus last year was 1,20,000, last year was 80,000. Last year was 80,000 and current year it is 1,20,000. So first of all we want what are the components of these reserves and surplus. So in the notes to accounts that is given in the problem. The problem below the balance sheet notes are given. In that notes you can find reserves and surplus. General reserve last year 30,000, current year 40,000. Then surplus in statement of profit and loss. Surplus in statement of profit and loss last year was 50,000, current year is 80,000. The surplus means profit in profit and loss statement. The surplus in profit and loss statement last year 50,000, current year 80,000. So 30,000 rupees surplus increase. So here I am writing Rohit Limited cash flow statement for the year ended 31st March 2017, current year. Cash flow from operating activities as usual. So how much is the increase in surplus? 30,000. Last year 50,000, current year 80,000. So increase in profit and loss statement is 30,000. So in bracket you can write down here 80,000 minus 50,000 given in the notes to accounts. This one over. Now adjustment for non-cash, non-operating items, right? For non-cash, non-operating items, we will see the balance sheet. We'll see the balance sheet. Intangible asset. Intangible asset. Last year was 50,000. Current year it is 40,000. That means intangible asset consists of goodwill, patent right, copyright, etc. These intangibles will be written off over a period. So last year it is 50,000, current year 40,000 means 10,000 rupees intangible assets were written off. It is not given in the problem, but just by comparing the figures we conclude. We make a conclusion that intangible assets may be written off during the year. So that written off intangible is a non-operating, non-cash item. It's a non-cash item. So intangible asset written off. How much written off? 10,000. That's all. Next one is transfer to reserve. If you see the notes to accounts, you can see last year general reserve was 30,000. Current year general reserve is 40,000. So last year general reserve amount was 30,000, current year 40,000. How it has increased? We can make a conclusion. during the current year 10,000 rupees are transferred from profit and loss account to general reserve. That is a valid conclusion. The general reserve have increased because during the year we have transferred 10,000 rupees. So transfer to general reserve 10,000 rupees. That's all. So two items are there which are non-cash and non-operating items. One, intangible asset written off, and second, transfer to general reserve. Add up these to 30, 40, 50,000. This 50,000 is called operating profit before working capital changes. Operating profit before working capital changes, 50,000. Now we have to make the adjustment for working capital changes by considering the current assets and current liability. First of all, you can see trade payable. The trade payable last year 40,000, current year 55,000. Trade payable is a current liability. The last year 40,000, current year 55,000. Increase. So increase in trade payable, add, because you can find the rule here. Increase in current liability, added. Increase in current liability, added. So trade payable is a current liability. It is increasing. So add. So here increase, increase in accounts payable. Accounts payable or trade payable means one and the same. How much? 15,000. 55,000 minus 40,000. 15,000. So current liability over. Now I am coming to the current assets. Current assets, inventory. Inventory is a current asset. Last year 50,000, current year 80,000. Increase in inventory, increase in current asset, deduct, because decrease in current asset is added. So increase in current asset should be deducted. So increase in inventory, see here, increase in inventory minus, difference is 30,000. So minus 30,000. One more is the trade receivable. Trade receivable is a current asset. Now last year it is 60,000, current year 1 lakh. Again, increase in trade receivable, deduct. Increase in trade receivable, deduct 40,000. Last year 60,000, current year 1 lakh. So 40,000 increased. So 40,000 we have deducted. That's it. So we have taken all current assets and current liabilities. So 50,000 minus 30,000 minus 40,000 plus 15,000. So minus 5,000. Result is minus 5,000. So we'll write the wording cash used in operations before tax. Cash used. If positive, cash generated. If negative, cash used in operations before tax. Income tax is not given. So cash used in operating activity is 5,000. Negative. Bracket denotes minus. So cash used in operating activity. Now cash flow from investing activity. Now see the tangible assets. Here tangible assets last year 1 lakh, current year 1,50,000. So during the current year tangible fixed assets increased by 50,000. That means purchased. Tangible fixed assets are purchased. So purchase of fixed asset 50,000. When there is purchase, there is cash outflow. So bracket. We have to see the transaction whether there is inflow or outflow. When we purchase something, cash goes out. The outflow, negative, minus 50,000. So this is the cash used in investing activities. That is also negative. Now cash flow from financing activities. For financing activities, check the share capital and debentures. So share capital, last year share capital 1 lakh, current year 1,50,000. Issue of shares. So issue of shares 50,000. Debentures. Debentures last year 50,000, current year 60,000. Issue of debentures. So issue of 6% bonds 10,000. 10,000. Take the total 60,000. So cash generated. Here debentures are given, not bonds. So I will write out bonds. Issue of debentures, not bonds. Actually bonds and debentures are similar. So issue of debentures 10,000. Total 60,000 outer column. So this is the cash generated from financing activities. It is positive. That's why I am using the word generated. Now see the outer column. Minus 5,000, minus 50,000, plus 60,000. You will get positive 5,000. You are getting positive. The net increase in cash and cash equivalent 5,000. To this we add cash and cash equivalent at the beginning of the year. The last year, how much was the cash and cash equivalent? It is given in the problem 15,000, no 10,000. Last year's cash and cash equivalent in the balance sheet is given 10,000. So cash and cash equivalent at the beginning of the year 1/4/2016 10,000. Now 5,000 plus 10,000, 15,000 rupees is the cash and cash equivalent at the end of the year, 31st March 2017. Now check, in the balance sheet you must have cash and cash equivalent 15,000. So cash and cash equivalent 15,000, and we also got 15,000. That means our calculation, our presentation is absolutely right. No mistake at all. So we have completed two problems in this video, that is fourth and fifth problem. So if you are satisfied with my lecture, give a like to the video. Share my channel in your group, in your friend circle, so that more students can watch the video and get the advantage from this channel. Give your comments on these videos, and lastly, don't forget to subscribe my channel if you have not yet subscribed. We'll continue inshallah the next problem in the next video.